Is London making a comeback? Over the last decade, many landlords have ditched the capital, driven away by high prices, low yields, and better opportunities elsewhere. But research suggests investors might be creeping back into London. So, what's changed? And should you do the same? To get to the bottom of it, let's take a look at why landlords stopped investing in London, what's changed to make it attractive again, and whether it's actually a smart investment right now. First, we need to understand why landlords left London. To do that, let's go back to 1995, when Ben is picking his side in the Battle of Britpop, still talking to his mates about Eric Cantona's infamous Kung Fu kick, and saving up for his first buy-to-let property. London isn't cheap, but it's still affordable for the average investor. Ben finds a two-bedroom flat in Clapham for £85,000. He puts down a 25% deposit of around £21,000. He gets a buy-to-let mortgage and locks in a low interest rate of 6.5%, which was considered great back then. And he gets a solid rental yield of 8%. He finds tenants quickly, and within a couple of years, the rent covers his mortgage and more. Ben watches his property steadily increase in value, and by the early 2000s, he built enough equity to buy another property. By the time 2008 rolls around, London prices take a hit, but then they recover faster than anywhere else in the country. So far, Ben's investment has worked out perfectly. But would he have had the same success 20 years later? Let's fast forward to 2015, when Ben's nephew, Josh, wants to buy his first London rental. But it's a completely different market. That same Clapham flat that cost £85,000 in 1995 is now worth £750,000. A 25% deposit is £187,500, more than double the total price of Ben's first buy-to-let back in 95. And rental yields are barely reaching 3% in prime areas. To make things worse, stamp duty has shot up, tax relief on mortgage interest is about to be phased out, and new regulations mean that landlords have more costs and responsibilities than ever. Josh does the maths and realises that even with rent at record highs, the numbers barely stack up. So he heads north, where he finds a 3-bedroom house in Manchester for £150,000. He puts down a 25% deposit, which is £37,500, and gets a solid rental yield of 7%, more than double what he'd get in London. His mortgage payments are lower too, meaning stronger monthly cash flow. For Josh, and many landlords like him, investing outside of London was a no-brainer. So what's changed? To work that out, let me bring you back to the present day. Josh has spent the last decade happily renting out his 3-bedroom house in Manchester, enjoying strong yields and steady tenant demand. In that time, he's made friends with other property investors, people who, like him, left London behind in search of better returns elsewhere. But recently, something strange has been happening. His investor friends are suddenly buying in London again, and it doesn't make sense to him. Wasn't London supposed to be a terrible deal? Isn't it still overpriced with low yields? Why go back when the north is working just fine? This shift isn't just anecdotal. According to a survey, London has seen a 13% increase in buy-to-let growth, the highest in the UK. That's above Birmingham and Leicester, which each recorded 12% growth in new landlords. Leeds at 11%, and Manchester and Nottingham at 10%. But why? Well, just before we get into that, if you want to get access to our data on the best places in the UK to invest, you can download our investment areas guide using the link in the description. So, to figure out why landlords are returning to London, we need to talk about the cost of living. Property prices in London have barely increased in years, but you can't say the same for rents. Rents were rising at 11.6% year on year as of late 2024. That's the fastest in the country, narrowly ahead of Manchester and Birmingham. There's also 15 applicants for every property, meaning landlords are finding it easier than ever to fill their properties, even at higher rents. Prices staying the same while rents go up. That's a recipe for higher yields. And while yields aren't quite as strong as they are in other areas, they are improving. So the numbers behind a London investment are starting to look more attractive. The second thing we need to consider is where landlords actually live. Over the last 10 years, we've helped thousands of investors from the southeast invest all over the country. But there's something reassuring about buying close to home. You know the area. It's easier to attend viewings. And if you want to do everything yourself instead of paying a letting agent, you won't have to spend an hour on the motorway to replace your tenant's light bulb. I'm kidding, hopefully they can do that themselves. So with many investors living in or around London, who can blame them for wanting to invest in the same city? For those who live nearby, London offers a level of convenience and comfort that they can't get anywhere else. Another thing to consider is that for some investors, the draw of London goes beyond numbers. It's about owning an asset in a city that's known around the world, even on Coronation Street. London has always had international appeal, That's one of the reasons it bounced back so quickly after the 2008 crash. Today, overseas buyers have to pay an extra 2% stamp duty on top of the 5% extra stamp duty that buy-to-let investors already pay, and that still hasn't deterred them, which is why the third reason London is making a comeback is prestige. So rents are rising, yields are getting better, and landlords are buying in London again. But is it actually a smart investment right now? Well, to work that out, let's look at the numbers. First, let's turn our attention back to Josh from earlier in the video. Josh heads over to Zoopla and starts pricing up family homes in London. The average property price in the capital is currently around £673,000. So to buy, he'd need a 25% deposit of around £168,000. For that, he could buy 2 properties in the northwest and probably still have change left over for the furniture. And despite the rental growth we talked about earlier, yields in London are still averaging only around 3.8%. Compare that to the 6 to 7% or more that you might get in Manchester or Liverpool, and for most people, it just doesn't make sense. So while things are improving in London, it still offers one of the weakest returns in the country. Many investors believe you buy in the south for capital growth and in the north for yield. But how true is this phrase today? In 1997, a property in the north cost around 75% of a London property. By the year 2000, that had dropped to 40%. And by 2017, the gap widened even further to just 30%. So you could buy more than 3 homes in the north for the price of 1 in London. More recently, it's crept back up slightly to 38%, but London is still significantly more expensive than the rest of the UK. That means that in historical terms, London is overvalued compared to the rest of the country, which means growth is likely to be higher outside London until the ratio comes back to its long-term trend. And indeed, while prices in London have been flat, cities like Manchester, Leeds and Nottingham have seen rising rents and strong growth. So now it's not just yield that's better outside London. Growth is too. And that's why even though London is looking stronger than it has done in years, and it has those all-important convenience and prestige factors, we're still avoiding London for the time being. But we're keeping an eye out for the right entry point because it will come eventually. But how do we know that? How do we run the numbers and make sure our properties are actually going to be profitable? Well, we invest over £100 million into property every year, so we needed to come up with a system. So if you want to find out exactly how we assess all our deals, check out this video next.